Hi, this is Ashish Shanker and I'm happy to present to you the Feb version of the Alpha Strategist. January ended on a very interesting note with the Union budget being presented. A lot of expectations were built in this budget because it is being presented in the backdrop of slower economic growth. There are challenges related to credit. There are also challenges related to transmission of interest rates and borrowing rates for corporates. So there were a lot of expectations around capital market relief as well, and people were expecting maybe long-term capital gains to go away, and of course there was expectations around dividend distribution tax to be abolished. Now we see this budget as a milestone in a series of events over the last 6 months. If one recollects, the interim budget was tabled in July of 2019, where the super HNI surcharge was tabled, and this surcharge was also made applicable on foreign investments, which caused a lot of anguish among FPIs. This led to a sell-off, post which the surcharge got waived on FPIs and markets recovered. However, since then the government has made a slew of announcements, and one of the biggest tax announcements was made outside the budget. The reduction in corporate tax rate to 25% and a lower rate of taxation for new manufacturing units of 15% was announced. We believe that those were historic announcements. Now, if those announcements were made in the 2020 budget, I think this budget would have been hailed as a historic budget. However, if you view this budget as one more milestone in series of announcements that the government has made to spur economic growth, I think the budget looks reasonably balanced. Why does it look reasonably balanced? If you look at the challenges in front of this government, over the last 6 years, although the headline fiscal deficit has been brought down under 4% and currently closer to 3.5%, the deficit under the hood, which is essentially state deficit plus the public enterprise borrowings, especially the enterprises which do not have assets or revenues like Food Corporation of India, which mainly disburses food subsidies to the less privileged part of the society, had ballooned, and the combined deficit was closer to 9%. And the government had many stakeholders to satisfy, principally the citizens of the country, foreign investors, as well as domestic corporates. And I think they've come good on all premises. Essentially, they have chosen to walk the path of fiscal prudence at the cost of cutting allocations to schemes like Manrega. We believe that this sets a good foundation for RBI to further ease liquidity because they walk the path of fiscal prudence. International rating agencies would also be happy. Now let's analyze what they have tried to do over the last few months. Essentially, the government has tried to put a lot of money back into the hands of corporates. Now corporates can either use this money to pay back to their shareholders, they can use this money to spur consumption, which is what a lot of consumer discretionary companies have been doing by doing promotions, especially the auto companies. Thirdly, at some point this money can be utilized to build capacities which will spur capital expenditure. Of course, that is a function of demand catching up and may take time in case of certain corporates. In the budget, they have made certain personal income tax changes. A big change which will impact your investments is the abolishment of the dividend distribution tax. Now what it does is that the dividend distribution tax goes away when equity dividend is paid or even equity fund dividend is paid, and it becomes fully taxable in the hands of the final investor. Now whilst this may be very beneficial for people in the lower income tax category or people with who file no income because they are retired or in the lower income bracket, it does increase the tax substantially for super HNIs. Essentially, if you take the highest rate of taxation currently in the country is 42%. So dividends distributed could be taxed at 42% in the hands of super HNIs, and that's a big change from the earlier regime. We believe that although it may tax promoters and super HNIs more, eventually it lays a ground for maybe lower taxes in the future as compliance increases. One fallout of this we see is that buybacks become more attractive as opposed to dividend distribution. So you may see more buybacks in companies which are cash rich and where they feel there is value on the table. For you as an investor, you need to revisit your mutual fund portfolio especially balance funds or arbitrage funds where you may have chosen the dividend option. And if you are in the highest tax category, the growth option makes more sense. So it is prudent to get in touch with your advisor and make those changes if we have not got in touch with you already. On the personal income tax, they have now created two structures wherein they have given people to choose a lower income tax slab in case you are not availing of deductions, and we believe it does make sense for people who are not availing of all the income tax exemptions. For people who are availing the income tax exemption, it may make sense to stay in the old regime. We've given that calculation in this edition of Alpha Strategist. Now this budget laid the perfect groundwork for RBI to further ease monetary conditions, and RBI did exactly that on 6th of February. What they did was, I think, even more historic than what the budget delivered. They've delivered on 2-3 counts. One, they've tried to ease liquidity by introducing another tool called long-term repo operations. So far, the banking system is already flush with 3 lakh crores of liquidity, but the challenge was this money is not reaching the borrowers who need it, or rates are not coming off for many borrowers out there. Now, under the LTRO, what the RBI has chosen to do, they have chosen to give money for 1 year and 3 years. So they are putting in more durable liquidity into the system, and to the tune of 1 lakh crores. So the system being flush with 4 lakh crores and durable liquidity coming into the banking system, I think should drag down yields, especially in the 1 to 5 year bucket. And they have done it predominantly because corporates borrow in this maturity range. Essentially, government is the most active participant in the longer dated market, which is 10 year, 15 year or 20 years, and corporates are most active into 1 to 5 year. We believe that this will ensure that term spreads, that is the difference between the 1 year borrowing rate and 5 year borrowing rate, will come off, and it will definitely benefit many corporates as well as individual borrower. The other thing it will also do is it will make it even more punitive for banks to keep liquidity with themselves. So net, we do believe that this will kickstart a credit growth cycle. It may take a little while, but it will happen, because ultimately even the demand side has to pick up. Demand side will pick up when there is demand in the economy and people want to do capex. They've also extended this 15% lower tax benefit on manufacturing to power companies. So what they've also done is they have created the government has created a very conducive environment for foreign investors to participate in infrastructure investments in India. So they've given a complete tax holiday for sovereign wealth funds for 5 years if they come and invest in infrastructure assets in India. So we believe that all this has the makings of setting in place an investment cycle. May take a little while to start, but I think it will definitely happen over the next few months. The base will also get favorable from a growth perspective. Remember, June quarter was the quarter last year when sales, especially in the auto sector, started decelerating very sharply. Now, on the back of this, we continue to believe that the message that we have put out in the January Alpha Strategist, that this is the year of depolarization, is set to accelerate. If you look at January itself, Nifty ended marginally negative, but the mid and small cap indices were positive in a big way. So there was a divergence in returns between mid and small caps and large caps. We believe it will continue to accelerate in favor of the broader market, and hence our theme of depolarization is likely to continue. Even in fixed income, we will start seeing the lesser rated borrowers begin to get money at lower rates. So we are very enthused about credit funds, especially credit funds which are investing in relatively safer instruments like AA plus and AA and maybe say single A plus issuers. And we are looking at those funds. We will come out with our recommendations shortly. Hence the theme of the Alpha Strategy is Das Capital, because we believe that Governor Das has probably done enough to put more liquidity in the system and set in place a platform which should eventually spur demand and kickstart the investment cycle. So we continue to recommend that people should do their allocations in equities through multi-cap strategies and not wait too long for any serious corrections. Similarly, in the fixed income space, we have been so far over the last year messaging that you should stick to very high quality corporate bond funds in the AAA space, which are basically roll down strategies We continue to message that, but I think incrementally we are getting very enthused with the credit space, and we are studying it very closely, and we will come out with our recommendations in that space shortly. That's basically our view. Thank you very much for a patient hearing. I hope this was useful. Thank you.